What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today we'll talk about saving more in 2023. This video is coming out on the 30th with New Year's just around the corner, so I thought it was a great time to talk about basically some New Year's resolutions, or at least something that I'm putting in place for 2023. And as I mentioned in a video a long time ago, that really tax planning should always begin before the tax year for which you're doing the planning. It's not something that we can do kind of right at the last minute before we file our taxes. So as I'm sure you've all felt, we've had a lot of inflation going on lately. Thankfully, some of the signs tentatively are that inflation is slowing down a little bit. Hopefully the hike in rates that the Fed has put in place has helped to slow down the pace of the increase in the consumer prices. And we think that maybe within 3 to 6 months or so, who knows, they might be able to really slow down those increases or stop them and then get back to a more normal monetary policy stance and get inflation kind of right around where they like it, which is around 2% or so. In any case, one of the benefits of this inflation, in a sense, is that, of course, a lot of figures are tied to inflation, and one of those things that's tied to it are the contribution limits for our retirement accounts. Probably the most impactful one is going to be increases to contribution limits for those of us that have a 401k, 403b, most 457 plans, or a TSP or thrift savings plan. This contribution has been increased by nearly 10%. That's $2,000 from $20,500 to $22,500. This is even better if you're above the age of 50, where the catch-up contribution has been increased by $1,000 to $7,500, meaning that if you're over 50, you could put up to $30,000 in one of these retirement accounts next year. Contribution limits for individual retirement accounts, or IRAs, have also been increased. This one's a little bit smaller, but still welcome. Limits have been increased by $500 from $6,000 to $6,500. That's not quite the nearly 10% that we saw in the 401k limits, but it's still close to 8% and still pretty good. On top of that, phase-out ranges have been moved as well. Whereas before, the traditional IRA phase-out range was between $68,000 and $78,000, that has been moved up to between $73,000 and $83,000. So all else equal, this would mean that people that had the same wage would be able to deduct more from their taxes on using a traditional IRA, or this hopefully helps those people that got raises to kind of not have lost sort of deductibility because of the inflation that we've been seeing. Phase-out ranges for those married filing jointly have also been increased, but it's pretty complicated depending on whether or not your spouse or yourself is covered by a workplace plan. So you can just look it up on the IRS and see all the details there. The Roth IRA phase-out range has also been pushed up. Before, you were phased out of being able to do Roth contributions at the range of $129,000 to $144,000, and that's been moved up to $138,000 to $153,000. Now, of course, if you're beyond that, there is the sort of whole like mega backdoor Roth kind of possibility, but that's something for another video. And if you're married filing jointly, this range has also moved up quite a bit, from the $204,000 to $214,000 range to the $218,000 to $228,000 range. On top of that, the Savers Credit, or the Retirement Savings Contribution Credit, has had the income limits increased in order to qualify for that credit. If you're single or married filing separately, that income limit was moved up from $34,000 to $36,500. For a head of household, that's gone up from $51,000 to $54,750. And for married filing jointly, it's gone up from $68,000 to $73,000. So a lot more people will be able to enjoy that credit, all else equal, though of course incomes have gone up. So yeah, we're really just adjusting to keep people from losing out. Overall though, taking a step back, this means that, you know, for people that qualify, they'll be able to get that credit, which is great. And then for people that don't qualify for that credit, the amount of investments that we can now shelter away from taxes for our retirement has been increased, and we should definitely take advantage of that if we're able to. Obviously, this is a luxury that not everyone has, and I'm grateful to be able to fully take advantage of it. So we talked about, the 401ks and the 403bs and all that, but I didn't talk about whether or not they're traditional versus Roth. And in the discussion of traditional versus Roth IRA, I just pointed out the phase-out limits, on those, the deductibility and eligibility for those, but didn't really talk about kind of which one's better. And of course, this one is a big subject, kind of up for debate. There's a great blog post by the Mad Scientist that I recommend checking out. In general, depending on what assumptions you have, it can really skew what you think the results are going to be. But taking a step back, given some kind of reasonable assumptions, probably it's just not going to be that huge of a difference between the two, depending on your situation though. So in my particular case, I'm kind of actually taking advantage of both. I'm contributing the maximum to my traditional 401k because I'm in the marginal 24% and 22% tax brackets for the income that I'm removing from being taxable at that rate. So the effective average is probably something like 23.25%, Well, let's say 23%. And so that's a savings of $5,175. And that's a pretty significant amount that, as long as I'm disciplined, which I am, I'm going to be funneling those $5,000 directly into investments. If I were taking the tax break, but then blowing that money somewhere else, then of course it wouldn't do any good, and I'd be better off doing a Roth. But yeah, that's not what's happening in this scenario. So I get to save on those taxes now, I get to invest more now, and that means it can compound and grow to a larger amount in the future. But on the downside, of course, in the future, I will have to pay taxes as I take that money out. And then also there will be required minimum distributions, or RMDs. This is like a calculation that the IRS makes you basically take distributions from these accounts above the age of 70 and a half previously. That limit's been moved up, I think, to around 72-ish. It'll depend on your cohort. But in any case, there are some downsides later on. So it's kind of like save money now, pay taxes later. Whereas with the Roth, it's the opposite. You get to contribute money that you've already paid taxes on now, but then it grows tax sheltered, and there are no RMDs when you reach the age of 70 and a half plus. So that's what I'm doing for my IRA. I'm going to be maxing out the Roth IRA in order to take advantage of that. Though actually the reason I'm doing it is, again, because I'm kind of in that phase out range for the traditional IRA. And rather than calculating, exactly how many dollars I can contribute to each one and splitting up the two buckets, just not worth the effort. Especially, again, like I said, the math kind of can work out to be pretty 50-50 on this traditional versus Roth thing. And so I'm just going with this easier traditional 401k and the full Roth IRA. So whatever the actual math works out to be for you, I think it's great that, thankfully these things do get adjusted for inflation, and that we're able to put more in tax sheltered accounts towards our future next year. So being under 50, we can take advantage of an additional $3,000 in tax sheltered investment space for 2023. And I think that's pretty great. Even if you're not able to make an increase quite as large as that next year, anything that you do would probably be a great idea for your future self. And there may be some other financial New Year's resolutions that you might make. One could be, certainly, if there's a 401k match out there that we're not taking advantage of, that's free money and definitely a huge rate of return if we're able to start contributing and get that 401k match, for instance. There may be a lot of other things you might be thinking about. Let us know your financial New Year's resolutions in the comments below. Hope you enjoyed today's video. If you did, please hit the like button and consider subscribing. If you'd like to support the channel, check out my referral links in the description, see if they're useful to you. Thank you very much for watching, and I will see you in the next video.